Thank you, CB, and a very good morning to my colleague, Ms. Anantha Thakur, friends, ladies and gentlemen. It's a privilege to join all of you here at the opening plenary of the CII Financing Summit 2025. Let me begin by thanking CII for convening this gathering of country's most influential voices across banking, insurance, pensions, NBFCs, and housing finance companies, private capitals, fintech, infrastructure, and the real economy. I would also like to acknowledge the leadership of the Department of Financial Services, which has partnered with CII to shape an ambitious agenda for this summit. This summit is especially meaningful for me because I had the privilege of initiating it with CII last year. It stands as a testament to what is possible when policy, markets, and institutions come together, not just to exchange ideas, but to forge implementation partnerships that truly matter. I listened with great interest to the remarks made by CB. The suggestions he made were thoughtful and timely, many of them consistent with the work already underway within the government, which my colleague highlighted very amply. I particularly welcome the emphasis on scale innovation and institution building, three pillars that will define India's next financial chapter. Over the past year, CII's engagement on issues such as sustainable finance, digital trust, and infrastructure development has created real and valuable momentum. Today, as we reflect on financing future growth, we do so at a moment when the global environment has shifted more dramatically than many of us expected. Major geopolitical events over the past year, too many to list, carry profound implications for India's present and future. The world may have irreversibly changed, compelling us to adopt a wider, more strategic lens. Globalization, already fraying at the edges, is being reshaped by geopolitical realignments, trade fragmentation, the race for technological dominance, and financial retrenchment. Capital flows, traditionally driven by market signals and macro fundamentals, are now increasingly influenced by political alignments and strategic considerations. For India, this presents a familiar paradox. On the one hand, we remain among the world's fastest-growing major economies with robust macroeconomic fundamentals. On the other, foreign investors continue to demand a higher country risk premium from India compared to several of our developing peers. As for Damodaran's January 2025 article, estimates place India's country risk premium at 2.93%, which is higher than Indonesia, the Philippines, and Mexico by 39 basis points, and higher than China by nearly 200 basis points. This reality forces us to confront a simple truth. For decades, global capital has complemented our domestic savings, supporting infrastructure, technology adoption, financial deepening, and private sector expansion. But if capital flows continue to gravitate along geopolitical fault lines, external financing alone will be insufficient to meet the scale of our development ambitions. If India is to fulfill its aspirations, the primary drivers of financing must increasingly come from within. External capital can and should supplement our efforts, but the strategic burden must rest on domestic institutions. Uncertainty can only be blunted by institutional strength at home, and our financial sector must evolve into our most reliable source of stability. Last year, I noted that fiscal, financial, and monetary decisions are inherently local. That is even more true today. At the same time, we cannot ignore the risks emerging in advanced economies. Financialization has deepened, often in ways detached from underlying economic realities. Rising asset prices alongside slowing productivity and weak employment growth, widening trade deficits, and persistent fiscal imbalances in the developed world are important fault lines. The global economic outlook of the International Monetary Fund brought out last month explicitly warns a potential bust of the AI boom could rival the dot-com crash in severity. Unwinding of these positions could entail a slow economic recovery hampered by capital misallocation, unquote. This should caution us against complacency. India cannot allow its financial sector to drift away from the real economy, nor can we afford vulnerabilities created elsewhere to spill over into our markets. Stability, resilience, and alignment with national priorities must anchor our financial system. Let me therefore outline our goals and what they require from India's financial institutions. For India to sustain its growth trajectory on its journey to becoming a developed economy, domestic drivers must be strengthened across at least 4 high-priority areas. 1. Industrial upgrading. Moving from assembly to higher value-added production. That means moving beyond import substitution to building strategic resilience, ensuring continuity and security of critical supply chains under geopolitical stress. 2. Harnessing the demographic dividend. Our population is young today, but this window of advantage is finite. Its full utilization will determine whether we rise to our potential or fall short. 3. Achieving near energy self-sufficiency. Ensuring that energy is clean, affordable, and reliable. Nuclear energy will have to play a central role, but the state cannot deliver this alone. The private sector participation is indispensable. 4. Deepening innovation capacity. India's R&D expenditure remains predominantly government funded. The private sector contributes only 1/3 of the gross research and development expenditure in India compared to 70% in the United States, 57% in the European Union, and 79% in China. This must change. To meet these 4 objectives, the financial sector carries a far greater responsibility than that borne by other sectors. This is not a task that reforms alone can deliver. It requires a shift in mindset. Business as usual financing will not suffice in an era defined by uncertainty and technological discontinuities. How we lend, how we assess risk, and how capital markets allocate value all must evolve. The banking system today is healthier than it has been at any point in recent memory. Non-performing assets have declined sharply. Provisioning has strengthened. Capital adequacy is robust, and liquidity remains comfortable. Regulatory efforts to enhance ease of doing business will further improve the operating environment. But balance sheet health is only the beginning. The next leap requires a move from balance sheet preservation to balance sheet deployment. Past credit cycles have left scars, leading to a preference for short-term lending, collateral-heavy underwriting, and a tilt towards incumbents over innovators. If India is to build productive capacity for the next decade and beyond, our financial institutions must provide patient, long-term capital that supports enterprises across their full growth trajectory, not just their immediate credit needs. That requires ambition, an ambition that reflects the scale of the nation's aspirations. Banks and financial institutions must become bolder, technologically sharper, and more willing to take calculated risks. India and the world stand at large inflection points. This is not an era for timidity. Innovation in financial products must accelerate in the following areas: blended finance for climate, robust urban infrastructure financing models, digital-first insurance, pension products suited to India's burgeoning gig workforce, and credit models rooted in alternative data. The transition to a high productivity economy demands that institution takes risks at the frontier, not merely where pathways already exist. India must also prepare for discontinuities such as the potential effects of the US Genius Act, which may become effective in 2026, and the rapid evolution of fintech. As my good friend and RBI Deputy Governor Ravi Shankar noted on the 7th of this month in this city, in the SBI conclave, banks face existential challenges that require deep introspection. Acquiring fintech companies may appear quick and convenient, but that does not address the deeper question of what banking fundamentally stands for. Tokenization and the disintermediation it brings are inevitable. Banking leadership must view discontinuous change not as a threat, but as an opportunity to reinvent and rediscover the true purpose of financial intermediation. Our capital markets too must evolve not just in scale, but in purpose. India's equity markets have grown impressively, but initial public offerings have increasingly become exit vehicles for early investors rather than mechanisms for raising long-term capital. This undermines the spirit of public markets. India cannot rely predominantly on bank credit for long horizon financing. A deep and reliable bond market is a strategic necessity, particularly for financing long-term national objectives. Insurance and pension funds, whose horizons naturally align with long-term investments, must play a larger role. However, the edifice of the bond market will be built on the foundations of trust and transparency, to which corporate leadership must commit on a durable and demonstrable basis. Globally, moral and visionary leadership in the corporate sector has become rarer, and what is rare is precious. Leaders in the Indian financial sector have a historic opportunity to lead in this regard. Financialization, which means the interest of finance run ahead of the real economy, may mean short-term gains, but undermines long-term economic competitiveness and vitality. The structural changes underway and still unfolding in the global economy pose challenges which can be turned into opportunities with long horizon thinking and execution. Here, I would welcome finance running ahead of the real economy and setting an example with long horizon thinking. Let me conclude with a few final thoughts. As we look ahead, we must recognize that none of the priorities I described will be achieved quickly or through momentum alone. Our financial system is stronger today than it has been in years, but we must not mistake strength for readiness. The demands the coming decade will place on our institutions are unlikely to be anything we have already encountered. India has reached a point where aspirations alone are no longer enough. Those of us entrusted with shaping the system must remain clear-eyed, disciplined, and also ambitious. We must avoid the temptation to celebrate prematurely when the road ahead is long, and as the poet reminds us, where there are miles to go before we sleep. Equally, we must guard against celebrating the wrong milestones, such as market capitalization ratios or the volumes of derivatives traded. These are not measures of financial sophistication. They only risk diverting domestic savings away from productive investment. In conclusion, I look forward to the deliberations at this summit and hope that the financial sector recognizes and embraces the historic opportunity before it. Thank you very much.